All right, everybody, we got a red day in the stock market, and especially a red day for Palantir. I made a video when Palantir hit 19 bucks and tried to give my analysis for why it was happening. I've also got to make a video when Palantir hits $14.41, down 6.7% so far as of around 12 p.m. that I'm recording this on the day. Obviously, a very red day for Palantir. As we can see, it hit $20.24, I believe a couple of days right before earnings. We are down significantly from then, around 27% at $14.43. The NASDAQ is down 13,423, and the S&P 500 is also down. Here we go, 439, below 440. We peaked at around 459, 460, July 31st, about 3 weeks ago. So, why is this happening? This is one of those downturns that's actually very reasonable to understand, and I want to go through some of the reasoning that I have. First couple of reasons are more macro-related and macroeconomic related, and the last one is going to be specifically why Palantir is down about 6%. So high-level overview to why Palantir is down, the entire market's down. If the entire market's down and the entire market is red, then Palantir is also going to be red. Now, why is the market down? So the market peaked, the S&P 500, at around 460 on July 31st. The all-time S&P 500 price was at 478. So the idea that in a year and a half from 2022, when we hit the peak, we would be right back to close to all-time highs is pretty unbelievable. Now, obviously, 2022, some prices got ridiculous. Obviously, Meta at $88, Tesla at $100 in January 2023, and inflation has been coming down rapidly. So as a result of inflation coming down, investor sentiment changing, a lot of cash that was on the sidelines coming back into the market, flooding it with more liquidity, the Fed printing some money to be able to save some of the banks, given what we saw with the Silicon Valley Bank collapse. That all allowed, not to mention ChatGPT and AI actually injecting all of this hype narrative into the market and really fueling a lot of investors to be more bullish than they probably were in 2022. That allowed the market to rally. All of those things, as warranted and justified and as rational as you can try to make them out to be, probably doesn't allow the S&P to be back at all-time highs back in from 2022. So as a result of that, I think a correction is required. It's necessary. It's important, and it's also very healthy for the market. Being at 460, very close to 478 on the all-time highs, going down to 420, nice little 10% correction. I think it's reasonable. Now, it sucks looking at your portfolio, especially if you're in some positions that can be incredibly volatile. Seeing Palantir go from 20 to 14 is not exciting. It's not fun, but it is mandatory because I don't think we could see Palantir at 25, 30 bucks. Those types of valuations just cannot be sustained in a world in which the macro doesn't support it. So a 10% correction I think is pretty reasonable. Does it go to 15%? Does it go to 8%? It could be within that range, but I think a 10% correction, S&P at 420, is pretty reasonable to be able to see. Now, a couple of other reasons why the market is down, which has led Palantir being down. CPI went up for the month of July. So we were at 3%, we went to 3.2%. A lot of this doesn't matter that much because housing is the majority of that inflation. And if you actually take away housing and rents that have now gone up to $5,600 in New York City, housing is at its all-time high in terms of actual home prices in the United States, and mortgages around 8%, all-time high on houses. It's a bad situation for housing inflation, and it's going to affect overall CPI. If you take that away, CPI is getting close to 2% or below. But because you can't take that away, you've got a CPI that is higher. So that CPI spike that we saw in the month of July, which we also may see in the month of August, that is also speaking a little bit of fears into the market, and that's why the market is red. Another reason, $5.5 trillion are in money market funds. This was updated yesterday. About $14 billion last week got added to these money market funds, which are essentially very low risk mutual funds that are not going to guarantee you some phenomenal return, but you could get 1 to 2, maybe 4% just having your money in these money market funds. And as a result of that, the idea that you would actually take your money into riskier assets like the stock market, where companies have to perform, they actually have to show results, they have to prove they're GAAP profitable, et cetera, it just doesn't make sense to a lot of investors in the market. Not to mention on treasury bills, we've seen this with Palantir, this is how they were able to maintain GAAP profitability. You can put your money into some T-bills, get 4 or 5% over 3-6 months, and that's not a bad deal as well. That's a much safer place to put your money versus in some of the other parts of the economy. So as a result of money market funds and treasury bills also being able to generate a return that is essentially risk-free, money's not in the stock market. Now, how does that $5.5 trillion enter into the stock market and enter into companies like Palantir again? I believe we need, as I was saying above, a correction. You need a little bit of some valuations to come down. If you look in the fear and greed index, we were extremely greedy on a scale of 0 to 100, 88 on July 31st. Now we're at about 55. So we're getting to neutral. We're getting into the fear territory a little bit. And I think if the S&P goes to 420, which is the 10% correction, we will be in peak fear, which will allow some of that 5.5 trillion to be like, why is our money in a low return in ETF mutual fund where we can really put it into some beautiful assets that are now at very attractive prices? And I think that will flood the market with some liquidity as long as inflation continues to tick down by the end of the year. So those 5.5 trillion that are on the sidelines, they're not in the market. I think they will come into the market, but there needs to be a catalyst for them to come into the market, and the catalyst is likely going to be a market correction, in my opinion. That's what would allow the market, the money to come to the market. Now, final thing on macro, and then we'll talk a little bit more Palantir. The Fed FOMC minutes came out yesterday, and they were pretty hawkish. And the reason they were hawkish, Kevin actually had some really good analysis on this, was because the Fed knows that they are seeing disinflation in a variety of different sectors of the economy. One of the biggest ones being commodities. China exports are down 24% in the month of July to the United States. If China's not exporting, China's economy is screwed. I mean, they need to be exporting. That is one of the bulk ways that they generate money for the economy. And so American companies that got tired of everything that happened in 2020 during the pandemic, the lockdowns, all that stuff, they started looking at different opportunities. Mexico and India are two of the different countries that have opportunities for American manufacturing and exports. So as a result of that, if China's not exporting that much, and they're likely not going to be exporting that much over the next 6 months, their youth unemployment rate has hit 20%. China's economy is getting to a point where we might have to be worried about deflation. So that impacts everything that the Fed is seeing. Again, if you take away housing from CPI, we're at 2% or below. The Fed pretty much knows they've won the debate when it comes to inflation. However, if they make it obvious, or in the words of macroeconomists, if they act very dovish that the economy is on the right track, more money will pile into the market. More money will lead to more spending. That may lead to increases in inflation. So they don't want a 1970s situation where in the 70s, the Fed thought they had done their job, and then inflation ticked up all the way to 18%, and then Paul Volcker had to get interest rates at 20% to be able to quell inflation, which then gave confidence back to the Fed. And again, Kevin had some amazing analysis on this yesterday. So as a result of that, it is more likely than not that even though the Fed knows they've won the inflation debate, they can't let the market believe that the Fed thinks they've won the inflation debate. Only 2 Fed officials wanted to keep rates where they were in the month of July. Everyone else wanted to raise them. And so as a result of that, I don't think we're getting another rate rise unless CPI in August is going to be insane. I mean, if it's horrible, then yes. But I think the Fed knows they've done their job. They can't let the market think that they know they've done their job, because the market can't get that excited. And as a result of that, expectations need to remain low, which means money needs to not go into the stock market. It needs to go back into money market mutual funds. It needs to go into ETFs. It needs to not go into stocks in order for inflation to be quelled, in order for the market to be able to have a legitimate correction and then be able to make the next leg up forward. So the Fed is being very strategic, in my opinion. They know they've been able to do the right job. They just have to make sure that the market doesn't believe that inflation is solved, so that there is not this much euphoria. All of those things, you put that together, CPI, Fed minutes being hawkish, 5.5 trillion in money market funds, a general correction needing to happen. On top of that, August and September historically are always bad for the stock market. I mean, there's just a little bit more choppiness given this timing of the year. You get a little bit of a correction, and we see companies like Palantir that were at $20 fall down to 14 and may fall even below that. Now, what is the reason for why Palantir in particular is down? I think it's pretty obvious. Earnings were not that good. As much as I loved earnings from a growth trajectory perspective for the future, there was no growth in earnings. 13% year-over-year growth when it was at $20, trading at 20 to 21 times price to sales. $40 billion company for barely bringing in $2 billion of revenue, only being GAAP profitable because of treasury bills, $45 million in profit, and most of that is from those T-bills that you got over the past 6 months. It's just not possible to sustain that type of valuation. At the end of the day, I know a lot of people want to talk about Palantir and its TAM and its opportunities and all that stuff, and I love talking about that stuff, but I've been very clear on my live stream for the past 6 months, every time I've gone live, that I thought 20 was overvalued, I thought 17 was overvalued. I was enjoying the run up, and I did not sell a single share, but at the end of the day, like, it was overvalued. I mean, like, you can admit when it's overvalued. You don't have to be in some cult where you're arguing that it's undervalued at a $40 billion valuation and they're barely doing $2 billion in revenue. So it was very obvious to me that Palantir was going to come down. I expected that to happen on earnings when they reported 13% year-over-year growth, but the market didn't tank them on earnings. They waited a couple weeks after, and now they're deciding to tank them, which is reasonable. Also, as soon as Palantir reported earnings, a couple of days after, you get the Moody downgrades and the Fitch downgrades. So all of that stuff kind of happens as a result of the days after Palantir earnings, which is just negative impacts on stocks, negative impact on the economy. That's one other macro thing I forgot to mention. All these Moody downgrades and Fitch downgrades that have been happening have basically said that the United States credit and their ability to default on their debt is more likely than it was in the past 10, 15 years, which is another reason why people are like, well, let's not invest in stocks. Let's put our money somewhere else so that we have a little bit more of a risk-free return. All of that combined with the fact that their earnings just didn't show the growth they needed to show on a numerical level, you're going to get Palantir coming down to a more reasonable valuation. Now, obviously, the clients in AIP and the potential for that to grow, the potential for them to monetize that, AIP Con 2 happening in September, all of these things are incredibly bullish. But it takes a real investor to read between the lines and see that that's happening in the future. It's not going to happen now. In fact, I'm okay with the revenue growth being small right now as long as customer growth is higher, because I know the revenue growth from those customers will come in the future. But you can't argue with valuation. If the revenue growth is not there right now, the revenue growth is not there, which is why if it gets down to 10, 11 bucks, that is a great opportunity if you believe that the revenue growth will be in the future as a result of monetizing AIP. Either you're going to be right on that or wrong on that, but a price that's much below 20 bucks gives you the asymmetric return to, if you're right on that, actually get a return versus having to bet at a $40 billion valuation. They will eventually make it $80 billion. So I am perfectly fine as a long-term Palantir investor that doesn't want to sell my shares till 2030 to have more opportunities at biting up and getting the dip. My average was 15, so anything below 15 I get more excited about. And it's not actually the worst thing in the world for me to be able to see this dip. So in general, yeah, the market's down. We might be headed towards this 10% correction on the S&P at 420. At that point, Palantir might be at 10, 11 bucks. And I think, honestly, if you're a long-term investor, you shouldn't be scared of it. Obviously, if you have some options, if you have stuff that's expiring soon, if you have options until 2025, I also think you don't really have to be worried. You've got a long time for that stuff to play out. But if you're in some short-term stuff, it is a little risky right now, especially over the next 2 months. Now, if we get an inflation with a 2 handle on it by October, November, I think I'm in the Tom Lee camp that the S&P can do very well. The market can do very well, but we've got to see that happen. We've got to see confidence from the Fed that they are going to eventually cut rates by 2024. And we've got to see some macro factors play out before we ultimately declare that the market's back into recovery mode and it's a bull market. So it's another 2 months of a little bit more bearishness, and ultimately we'll see what happens by the end of September. Those are my thoughts. Let me know what you guys think about Palantir being down today, and overall how you think about the market handling Palantir being down 6-7%. Let's take one last look at it before we end the video. S&P at 439, Palantir at 1437, so down basically 7% for the day. It's a red day, folks. It's a red day, but it happens. Thank you guys so much for listening and watching. I appreciate you. I will see you in the next one.